Hello, everyone. Firstly, I hope all of you are absolutely safe and sound. I know across the country, most of them have already opened up. Work from office has started off on a roster basis, on a regular basis. And of course, the pace of vaccination has also picked up real momentum. However, it's important to be very cautious despite all odds. So be well masked and take good care of yourself. On the debt markets front, the month of September were characterized by multiple things. The most important thing was anticipation of what lies ahead in the October policy. Of course, crude was on a boil, so that was tempering down the sentiments a little bit for the bond markets, and that were reflected in the bond yields as well. However, the liquidity scenario continued to remain fairly comfortable, which probably meant that there would be something coming up in the monetary policy. To focus on the policy, because that is the event just gone by, the bond markets, a section of the bond markets were expecting an uptick or a revision upwards in the reverse repo rate, and that was already reflected in the bond market sentiments and the yields. In fact, through the last 30 to 40 days, the very short end of the yield curve had already inched up anywhere in the band of 15 to 20 basis points. It therefore came as a small surprise to some sections of the market that the Reserve Bank of India, in its MPC, chose to remain status quo across rates. This was, of course, in line with our expectations. Our premise has always been that it has to be a slow and a gradual, phased manner. A, normalization of liquidity. B, look towards narrowing the reverse repo and the repo corridor. 3, change the stance towards neutral. And last but not the least, look to hike the repo rate. At the current juncture, we believe the Reserve Bank of India will focus on the first two parts, which is normalizing the liquidity. The current liquidity in the banking system is close to about 12 lakh crore, and therefore we have seen an increase in the VRRR amount by additional 2 trillion rupees. Now, this is largely in the 7-day and the 14-day bucket. However, there is an open chance because the probability has been left open that the Reserve Bank of India could consider 28-day VRRR as well. Obviously, this has been intended to normalize the liquidity over slightly longer period rather than just 1-day basis. So that was it which we saw in the policy. We also saw a slightly more tolerance towards a potential for yields moving up. And why do we believe so? That's because we did not see any introduction of GSAP, which is the secondary market GSEC acquisition program, for the quarter of October, November, December, which we saw in the previous 2 quarters. Also, Operation Twist, where the Reserve Bank of India buys long bonds and sells short bonds, that has been left to a probability in the future if there is a need. However, there was no commitment or a timeline into which that will be conducted. So that was a small disappointment for the markets, which is why the long end of the yield curve, which is the beyond 10-year segment, reflected in yields moving up. However, given the commitment to phase out liquidity or normalize liquidity in a gradual manner remained, we did not see that kind of a negative impact at the very short end of the yield curve. The inflation in the next couple of readings is also likely to be on the lower side, which is why the Reserve Bank of India was prompted to lower the inflation guidance for the entire financial year FY 2022. What is the view going forward? Well, we believe that this progression seems to be a step in the right direction. It's also how some of the global central bankers are behaving. For now, the central banker will leave no stone unturned to ensure that growth as a priority remains, so long as inflation is within tolerable limits. Hence, for fixed income investors, the potential to earn the carry as a proposition continues to remain the order of the day. So those who are invested in fixed income, please try to match your horizons to the extent possible with the portfolio durations. There may be some small mismatches, I don't deny, but it's very difficult to invest in with a 3-month horizon with portfolio durations north of 3 years. But small mismatches, as I said, is absolutely okay. And the steep yield curve, even right now, provides for cushion if there were to be abrupt movements across the curve. So for now, anything at all possible in terms of big events probably could be in the December policy. The verdict is still not very clear. It is still the toss of a coin if we actually could see the embarking of the narrowing of the corridor in the December policy itself. But for now, we need to wait for some more data points, including the macro data points, global as well as domestic, to take that call very meaningfully. Till then, stay invested and enjoy the carry. Take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.